All right, Adam. So have you got the clicker there? Yeah, all set up? Okay, perfect. Right. Adam, first question. Talk to us about how you and the guys at News Squawk prepare for major central bank meetings, and in this case, specifically the all-important ECB meeting. How do you assess the various outcomes and the potential reaction in the market? Importantly, how can traders learn from your process to help them navigate key risk events and digest what is signal and what is noise?
Cool, yep. So I'm Adam Linton. I run the desk over at News Squawk. So basically, we're a live audio feed. We kind of cover breaking news, commentary about ongoing market moves, then coverage of live events, kind of like your ECBs, your non-farm payrolls, etc. So I'm obviously an analyst, I'm not a trader, but one of the things that kind of distinguishes what we do is we're working in a live environment. So we're there in the second, we're having to decipher things very quickly. So it means we're kind of approaching these events. We need to know exactly what we're looking out for. So when it kind of comes to the day, what's kind of signal and what's kind of noise. So my presentation today, I'm kind of going to work through kind of my process. If someone was to say, Adam, you're going to sit on the Squawk tomorrow, how are you going to get prepped for this event? What are the key things you're going to be looking at? So when the release happens, you kind of just rattle through it and kind of have a coherent narrative as to everything that's going on.
Next question, Adam. Give us a bit of background on how ECB policies sort of developed and evolved throughout the year and what has happened since the prior meeting, you know, data, key commentary, other central banks potentially influencing them, etc.
Cool, yeah, so this is the first slide. So in terms of kind of when you approach these events, I think the top tip is kind of never kind of look back just like kind of 2 weeks and think this is okay, I've read these kind of few articles in the FT, this is kind of what I think will happen. You need to have kind of a good kind of background on kind of how we've arrived, how we have, and take yourself back a few meetings. So for the ECB specifically, if you take yourself back to December 2021, we saw the ECB kind of confirm that they're going to end their bond buying program, their emergency bond buying program, PEP, in March. We saw that though it's a relatively tentative decision to do this, as at the same time in April, they're also going to beef up APP, which is their conventional bond buying program. Then when it comes to rate hikes, that was very much seen as a 2023 story. If you then fast forward to February, so this means actually pre the invasion of Russia, we began to see like a little bit of a less of a pushback on the prospect of a 2022 hike, as some of the more hawkish members of the governing council started to get a little bit more jittery. Fast forward to March, we then saw this hawkish pivot on asset purchases, whereby we saw the ECB announce that purchases under APP will be concluded at some point in Q3. We also then saw some new guidance on rates. Then the April meeting was kind of one that stressed the maximum flexibility and ultimately just kind of treading the water until June, which is obviously the meeting tomorrow. In terms of other things I want to be aware of, I want to know the inflationary backdrop. So this is actually a slide taken from the chief economist at the ECB. This is actually pre the most recent inflation release, but it kind of puts things into perspective and kind of how they're kind of viewing the debate. So the thick blue line is the actual realised path of inflation, and then got the yellow line, which is objections from March about the future inflation, the dark green, that's December, and working our way back. We're kind of seeing this common theme that the near-term inflation profile has basically been consistently revised higher. However, over the medium term, you just kind of go through 2023, 2024, it shows that we're kind of converging closer to this kind of 2% level, with the 2024 projection around 1.9%. So it's kind of this message of short-term inflation is going to run wild, but hopefully it's going to dissipate. We're going to come closer to target thereafter. And then this is actually a market-based gauge of inflation expectations. This is the five-year forward, which is essentially what the market itself thinks is going to be the inflation in 5 years' time over a 5-year time horizon. And this was actually referenced specifically by Christine Lagarde, who is the president of the ECB. And what you can kind of see here is the thick grey line is kind of where we saw the depths of the pandemic. Before that, we're kind of straddling below 2%. Then since there, it's kind of in one-way traffic, and we're at very much elevated levels. And this was actually something which was referenced by Lagarde, where she said the era of kind of that sub 2% inflation going forward is likely over for now. And then this is kind of my attempt at technical analysis. I'd like to apologise for anyone that's slightly more qualified than I am. Nonetheless, I did try to get the crayons out for this one. And this is more for like illustrative purposes. But basically, we're in this 111 to 115 band at the start of the year. Russia, Ukraine came along. We kind of broke out of that. And then as some of the Fed's tightening expectations kind of ramped up, we kind of plumbed that 103.45 mark. And as ECB were getting more hawkish, we've kind of picked up since there. So it's kind of showing me that if there's disappointment on the day, there is kind of some scope to the downside to kind of retest those lows. The most important thing out of all of this, if you want to frame your expectations for any event, particularly for central banks, is what's coming from the horse's mouth, okay? So these people, they're paid to guide policy expectations, and I think they've actually done a relatively good job ahead of this meeting. So you have ECB's de Guindos, who's the Spanish representative. He was kind of the first of kind of more dovish contingent who put the prospect of a July hike on the table. Thereafter, you saw comments from Villeroy, who's the French representative, who said 2 week a euro would go against their inflation target, as in if it's too soft, it would basically have too much of an upside impact on inflation. So this kind of shows me that the softness of the euro is playing a role in the decision making of the ECB, which is something you want to be aware of on the day. Thereafter, and probably the most important interjection you saw from Lagarde on the 23rd, who said the ECB are likely to be in a position to exit negative rates by the end of the third quarter. So if rates are at negative 50 basis points, that implies around about 225 basis point moves at the July and the September meetings. Then we saw the chief economist Lane, so that 25 basis point increments going forward are the benchmark. So it kind of gives you a bit of a basis to go forward. And then we saw Holzman, who's a slightly more hawkish, aggressive member of the governing council, said the inflation print backs the need for 50 basis points worth of tightening. So it kind of shows kind of the factions and kind of thoughts of what's going to be going into the June and the July and September meetings. And then finally, for this part of the presentation, this is basically market pricing. So if you see the implied basis point column at the bottom there, and you marry up with December, you can see by year end, there's 130 basis points worth of tightening. So if you take the 4 meetings after June, that implies it's going to be 3 25 basis point hikes, and then it's going to be 1 50 basis point hike. That's what the market's kind of going with.
Okay, great. I'm glad you covered that, because that was something that I was actually very interested in. Obviously, if they don't hike at tomorrow's meeting, the market's saying they're going to go 50 at one of them, and from there it looks like it's going to be September, between that July and September period. So obviously this is all about trading the headlines. What are you expecting for tomorrow's policy announcements? What do you think the market will be most sensitive to?
Yeah, so this is kind of one of the key messages when I was kind of asked this is, when you kind of see these headline events and kind of all these releases, you may go into it and think, okay, they're going to do this, they're going to do that. But the central banks have a very specific way of kind of communicating the way that they're going to carry out their policy or the decision they've made. So I always kind of want to take a look at the statement, because every headline you see is going to be derived solely from this document that's released at 12:45. So kind of familiarize yourself with the language, see how things are framed. So when you hear the headlines, you see the news, it's kind of ingrained a lot more in your mind. You're not kind of trying to find your feet as much as you otherwise would be. So in terms of the way it's typically covered and the way the market sees it, you get the top line immediate policy expectation. So this will be for the interest rates. So rates are set to be left unchanged. You may ask why, given that we've got inflation of 8%. Well, the ECB have made the judgment that they retain more credibility by literally doing nothing, but sticking to their sequencing, which says it needs bond purchases to end, that then rate hikes can take place, rather than actually doing anything meaningful about inflation in the interim. So this is kind of the one thing that I'm kind of thinking heading in tomorrow when I'm going to be sat on the mic is the bar for a hawkish surprise to kind of exceed market expectations is relatively high tomorrow. One thing they could do, if they want to be serious, is they could defy the market expectations and they could just pull the trigger tomorrow. This is one thing that I think personally they should do. It's not my base case, but just like as if you were trading, or if I'm going to be squawking it tomorrow, you can't be complacent just thinking, okay, the market assumes this will happen. But realistically, if you're kind of looking at how things have progressed, I think there is a live chance they could possibly do this. And if they do that, then the rest of what kind of follows isn't really particularly that relevant. So then when it comes to asset purchases, I think they've been pretty clear. Bond purchases, they're going to finish on July 1st. The new tool element is, so one of the problems is when they start hiking rates, there's kind of this concern you're going to see a blowout between some of the core spreads, the government bond spreads, such as Germany and those of Italy. So one thing you could potentially see is at some point they're unveiling of a new tool to kind of counter this. I don't think we'll see that tomorrow, but I think you could see some of the tightening up of the language around their commitment to avoid fragmentation going forward. Then also, rather than just looking at what they're going to do today, what they're going to do tomorrow, any guidance on the future interest rate hikes. We've already heard from Lagarde that they're going to look to hike take out negative interest rates by the end of Q3. Whether there'll be that explicit and actual formal statement, I'm not too sure. And if they're not, then that could potentially be a source of disappointment on the day. So when the fun at 12:45 is all over, you then have the joy of sitting through the press conference with Christine Lagarde. So in terms of kind of the choreography of that, the initial part is kind of the rehash of the statement, what we saw at 12:45. So make sure you kind of have that down pat, make sure you have a clear idea of what's happened. You then have a qualitative assessment of the economy, their kind of description of what's been going on. Then in this one, you have the quantitative assessment of the economy, which basically they're macro projections. In the near term, we're going to see inflation rise higher, growth lower. But again, that 2024 projection is going to be the one that I'm looking at tomorrow, okay? So how is it aligned with their target? If they can kind of see it above the target, like 2%, 2.1%, 2.2%, then to me that says they're giving the green light to the market to be even more aggressive, and maybe Westie will be right, and they're going to start hiking rates 50 basis points a meeting. I don't, for what it's worth. And then you have the Q&A section, which is typically actually the more interesting bits. This is when all the journalists, they're licking their lips, kind of looking to trip Lagarde up so they can move euro dollar 100 pips and get a pat on the back for their boss. So she'll likely be grilled on things about the future direction of policy. If she doesn't potentially do something like leave the prospect of a 50 basis point hike on the table, you could see some disappointment on the day, and that could ultimately be possibly a euro negative. You'll also see some questions on fragmentation, the issue I kind of touched upon earlier. And then also the kind of unanimity of the decision making. There's always kind of question on that. How unanimous were they in their decision making? She kind of tries to put an overly optimistic spin on it a lot of the time. And that then kind of paves the way to, after the meeting, typically a few hours, you often see these kind of source reports, which basically where a disgruntled member of the governing council kind of rings up someone at the FT and they're like, no, that didn't happen today. And in fact, what we actually said was this, blah, 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 and this is what I'm going to be saying ahead of July. And sometimes that's actually more interesting than any of the other stuff, and that's kind of where you actually get the market move thereafter. So it's definitely one to kind of keep on your radar.
Great. That was a nice overview of, the initial announcement, the statement, and then the press conference afterwards, the segments that we have to look for. So Adam, the next one obviously is, clearly the market's expecting a reaction FX. I looked at overnight volatility just before I came here, actually, in euro US dollar, and it's pretty punchy to say the least. So do you actually expect much in the way of a market reaction? And if we do see a reaction, what asset class do you think we'll actually see that in?
Yeah, so as I kind of alluded to earlier, I think the bar for a hawkish surprise is relatively high tomorrow. We've kind of come relatively fast, relatively soon, if you kind of cast your mind back to my fantastic euro-dollar chart. So therefore, I think kind of my bias would be kind of towards the downside. I think to kind of exceed those expectations tomorrow is going to be relatively high. But in terms of actual legs of that move, I don't think it'd be too much of a sustained move to the downside if you do see it, because regardless, rate hikes are coming, we know this, and then you'll see all the hawks in the governing council hit the news wires probably over the course of the next week thereafter. I think if you're a fixed income trader, the issue of fragmentation, that's clearly the big one. A lot of the bond vigilantes will be looking to kind of dump Italian paper and kind of test the ECB's nerve on this. So that's definitely one to watch. Then equities, my personal preference for equities is when it comes to monetary policy making and kind of ECB day, is people like, for example, the DAX, they're talking about trading the DAX. Well, the DAX is an index of 40 companies. There's only one bank in it, and it doesn't actually make that much of the index. If you look at the DAX, there's a lot of automakers, industrials. For me personally, I kind of think whether the ECB hikes in 25 basis points in July or 50 basis points, I don't think it really matters that much. I think if you're one of those companies, you care more what's going on in China, you care more what's going on in Russia and Ukraine.
All right, Adam, so to end off with your presentation, to give us a quick outlook for the ECB and the feed through to the euro.
Yeah, so obviously these are kind of intertwined. When I think it comes to following central banking at the moment, I think you need to have a meeting by meeting approach. You can't be too flexible. If you look at how far we've come over the past few weeks, then you're trying to make a call in December. I think that's essentially a bit of a fool's errand at this point. I saw one bank, they put a call which went out to 2026, which is nothing short of absolute lunacy. I think also as we kind of progress throughout the year, will the window for interest rate hikes close? So some of the headwinds from this decision to kind of turn off the taps on Russian oil, that's likely going to hit the Eurozone economy later in the year. And then you kind of got to ask yourself, some of the more dovish members of the ECB, what's their kind of stomach for this? Are they going to be willing to hike into the slowdown? My kind of suggestion is possibly not. Then also you'll kind of want to be looking, is this a normalization phase or a tightening phase? They kind of want to bring policy back to natural kind of more neutral stance, or as the end game, they actually want to make it more restrictive. I kind of think that debate kind of over the coming months, more towards the end of the year next year, if they do kind of advance in this rate hiking cycle, I think that's going to be the interesting thing to watch. And then again, this fragmentation thing, I think I've said the word fragmentation about 50 times today. But if you kind of see a bit of a blowout in some of these kind of peripheral and core bond spreads, then I think it's going to be something which could potentially slow down the ECB, because otherwise they're going to potentially need to start buying bonds. And even if they don't call it QE, the market will see it as QE. And I think that could potentially cause a bit of a credibility issue for the ECB. In terms of the euro specifically, again, have we reached peak hawkishness? We've seen the market pricing. We know it's relatively aggressive. Is there much scope to get more aggressive from here? I think Russia-Ukraine is obviously an important factor for me. I don't think there's really any upside from this, even if there's like a peaceful resolution to the conflict. I kind of think even if there was, the Russian oil taps aren't being turned on. A lot of those companies which left Russia, they're not coming back. Also as well, if trading euro-dollar, you always kind of got to remember the euro element is only one half the equation. Obviously, you kind of got to keep an eye on the Feds. I think ultimately, if the Fed starts adjusting policy, I think that'd be more of a dominant force than anything the ECB is doing. I think actual potential tailwinds for the ECB could be China. If China kind of becomes more online, kind of abandons their zero COVID strategy, then I think it could be potential tailwinds for the ECB. Then also as well, I think, without getting too philosophical, there's always an unforeseen event around the corner. At 2020, nobody had COVID in their playbook. Started 2022, very few people had Russia-Ukraine in the playbook. And if they did, I don't think they'd expect the magnitude of events that we've seen kind of unfold. So I think you just need to be nimble, stay on top of global events. And as you kind of get kind of the start, you kind of see things boil to the surface, be ready to act when it gets to that.
Adam, listen, just before I let you go, this fragmentation risk that I've been drinking my sparkling water every time you said it. I've made a new drinking game for myself.
God, yeah.
Look, the fragmentation risk, the blowout and the peripheral spreads, chiefly the Italian tenure and the core tenure. Surely, if they come up with this bespoke instrument that they keep talking about, or they use the reinvestments from PEP, that removes that fragmentation risk. What's your view on that? That's the last thing I want to ask you.
So the research I've read is that the reinvestments of PEP just won't be big enough. And also because people know this is a trade and they want to test the method of the ECB, I think they'll push it as much as they can. And also as well, I think the ECB aren't going to want to be too gung-ho and just relentlessly buying bonds. By that point, if they are in the position to do that, they're just going to be less aggressive hiking rates.
Okay, so don't fight the Fed does not apply to the ECB. You can fight the ECB.
You should fight the ECB. That's my advice for tonight.
Right, Adam, thank you very much. That was a great presentation to end the event, and I think your overview of tomorrow's pivotal ECB meeting is going to be nice and fresh in our clients' minds. Well, ladies and gentlemen, that brings to a close our second edition of Pepperstone Talk.